There's a secret that China has been hiding for 15 years. A secret so explosive that when it goes fully public, it will rewrite the global financial order. And 3 days ago, pieces of that secret started leaking. Not through official channels, through satellite imagery, shipping records, and gold industry insiders who can no longer stay silent. China has been accumulating gold on a scale that makes every official number look like a lie. Not 2,000 tons like they officially report, not 5,000 tons like analysts suspected, possibly 15,000 tons. Maybe more, enough gold to back a currency, enough gold to challenge dollar dominance, enough gold to fundamentally reshape how the world stores wealth. In 1971, the United States held 8,000 tons of gold. They claimed it backed the dollar. When France demanded to exchange dollars for gold, when the world started questioning whether America really had the gold, they claimed the entire Bretton Woods monetary system collapsed in weeks. In 2001, European central banks held 12,000 tons of gold when they started selling it off, declaring gold was a barbarous relic with no place in modern finance. The gold price collapsed from $350 to $250. Their selling crashed the market. In 2008, China officially held 600 tons of gold, barely a footnote in global reserves. Today, they officially claim 2,100 tons. But satellite imagery shows vault construction on a scale that can only hold one thing: refineries processing volumes that dwarf official import numbers, gold jewelry demand that doesn't match the physical gold arriving at Chinese ports. The math doesn't work, the official numbers are impossible, and the truth is about to come out. This is the story of China's secret gold accumulation, how they hid it from the world for 15 years, and why the revelation of the true numbers will trigger a market shock that destroys dollar dominance and sends gold to prices nobody thought possible, and investors are already starting to panic. Welcome to Boring Economy, where we investigate the stories that change everything. Look, you're not here for surface-level market news. You're here because you understand that the biggest moves in finance happen in secret, that official numbers lie, that governments manipulate data, that the truth only comes out when it's too late to position for it. If you want analysis that connects dots the mainstream media ignores, hit that subscribe button right now, smash that like button, because what I'm about to show you is information that could change how you protect your wealth. And when this story breaks completely, when the full scale of China's gold accumulation becomes undeniable, when markets realize what it means for the dollar and for gold prices, you'll already understand. You'll have been ahead of the panic. Now let's talk about what just leaked and why it changes everything. 3 days ago, a gold industry analyst published satellite images of a facility in Shenzhen. The facility is officially listed as a logistics center, warehousing for electronics components. Nothing special, but the satellite images show security that doesn't match a logistics center, armed guards, perimeter defenses, underground construction, and most telling, power consumption consistent with climate-controlled vault storage. Climate control for electronics, possible, but the power signature matches vault facilities in Switzerland and London. Facilities that store gold. The analysts published transport manifests showing gold shipments to this facility, not small shipments, container-sized shipments, hundreds of tons per year, flowing into a logistics center that officially handles electronics. The manifests show origin points in Switzerland, in London, in Australia, gold refineries and storage facilities, all shipping to a Chinese logistics center. The numbers don't match China's official gold import statistics, not even close. China officially imported 1,000 tons of gold last year, but the manifests showing shipments to just this one facility total 600 tons. One facility, 600 tons? And China has dozens of these facilities across the country: Shanghai, Beijing, Guangzhou, all officially listed as logistics centers or manufacturing facilities, all showing the same security profile, the same power consumption, the same shipping patterns from gold origins. If one facility is receiving 600 tons and China has 20 such facilities, that's 12,000 tons per year in gold imports. Not 1,000 tons officially, 12,000 tons. And that's been happening for a decade. The scale is staggering, the deception is comprehensive, and the truth is starting to leak. Before we talk about what this means for markets, you need to understand how China has hidden this accumulation. Not just the physical hiding, the entire system of deception that kept the world blind for 15 years. Let me show you how they did it and why the methods are starting to fail. In 2009, China announced they had been secretly accumulating gold. Their official reserves jumped from 600 tons to 1,000 tons overnight. The announcement shocked markets. China had been buying for years without telling anyone. Gold prices jumped from $800 to $1,000 in weeks. Investors realized China was a major buyer. Central banks started questioning their own gold policies. If China was buying, maybe gold wasn't obsolete, but here's what nobody realized at the time. The 1,000-ton announcement was still a lie. China had far more than 1,000 tons even then. The announcement was strategic, a way to explain increased gold holdings without revealing the true scale. A limited hangout, admit to something small, to hide something massive. Stage 1 was the domestic purchase program. China didn't just import gold from international markets. That would show up in trade statistics. Instead, they required domestic gold mining companies to sell all production to the People's Bank of China. All of it. China is the world's largest gold producer, 400 tons per year. Every ounce mined in China goes directly to the central bank. None of it exports, none of it reaches the international market. This gold never appears in import statistics. It's domestic production, but it's been accumulating for 20 years. 400 tons per year for 20 years is 8,000 tons right there, hidden in plain sight. Stage 2 was the indirect import program. China couldn't import massive amounts of gold directly without alerting the world, so they used Hong Kong as an intermediary. Hong Kong would import gold from Switzerland, London, Australia. The gold would sit in Hong Kong vaults briefly, then it would be shipped to mainland China. But the statistics would show Hong Kong importing the gold, not China. The trade data would show gold flowing to Hong Kong, and most analysts assumed it stayed there. For years, Hong Kong imported over 1,000 tons of gold annually. Most of it went to China. But because Hong Kong is technically separate in trade statistics, the imports didn't show up as Chinese demand. This went on for a decade. Over 10,000 tons of gold flowed from Hong Kong to China, hidden in the statistical separation between Hong Kong and mainland China. Stage 3 was the jewelry and industrial disguise. China is the world's largest gold jewelry market. Official statistics show Chinese consumers buying 200 to 300 tons of gold jewelry per year. But here's the trick. A significant portion of that jewelry is melted down and refined into bars. It goes to jewelry stores as fabricated jewelry. It gets sold to consumers. Then it gets sold back to gold dealers. Melted, refined, delivered to the People's Bank of China. The statistics show jewelry demand, but the end destination is central bank vaults. This accounts for another 100 to 200 tons per year. For 15 years, Stage 4 was the unreported accumulation. China simply doesn't report all their gold purchases. They announce increases, occasionally, and in 2009, they jumped from 600 to 1,000 tons. In 2015, they increased reported holdings to 1,800 tons, in 2019 to 2,000 tons. Each announcement presents the increase as recent purchases, but the accumulation has been constant. The announcements are just revealing small portions of holdings accumulated years earlier. They control the narrative. They decide when to admit to purchases. They decide how much to reveal, and they reveal far less than they actually hold. These four mechanisms, domestic production, Hong Kong indirect imports, jewelry disguise, and unreported accumulation, have been running simultaneously for 15 years. 400 tons from domestic production, 1,000 tons from Hong Kong, imports 200 tons from jewelry recycling, and unknown amounts unreported, that's over 1,500 tons per year. For 15 years, that's over 20,000 tons, not 2,000 tons officially reported, 20,000 tons, possibly more, if the unreported accumulation is larger than estimated. This would make China the largest gold holder in the world, larger than the United States, larger than the combined holdings of the Eurozone, the largest gold accumulation in human history. Hidden, deliberate, strategic, and the evidence is starting to leak. Now let's look at historical precedent. Because China isn't the first country to secretly accumulate gold. And history shows what happens when secret accumulation gets revealed. 3 times in modern history, secret gold accumulation has been exposed, and each time the revelation triggered massive market moves and geopolitical consequences. In 1968, the London gold pool collapsed. For years, central banks had been coordinating to suppress the gold price and maintain dollar convertibility to gold at $35 per ounce. The United States, United Kingdom, Germany, France, Switzerland, Italy, Belgium, Netherlands, 8 countries, all selling gold to keep the price at $35. The pool worked by pooling gold reserves and selling them whenever private buyers pushed the price above $35. Private demand would drive the price to $36, and the pool would sell gold, price would fall back to 35. This went on for years, maintaining the fiction that dollars were as good as gold, that $35 would always buy an ounce of gold, and that the Bretton Woods system was stable, but France, under Charles de Gaulle, was secretly demanding gold for dollars while publicly supporting the pool. France was playing both sides. De Gaulle understood something other leaders refused to see. Dollars were being printed faster than gold was being mined. The United States was running deficits to fund the Vietnam War and Great Society programs. They were creating dollars far in excess of their gold reserves. The math didn't work. Eventually, there wouldn't be enough gold to back all the dollars in circulation. De Gaulle wanted France's gold before that reality became obvious to everyone. Stage 1 was the secret accumulation. France exchanged billions of dollars for gold at the official $35 per ounce rate. They demanded physical delivery, not paper claims, not certificates, actual gold bars. They sent warships to New York to pick up gold from the Federal Reserve vaults. French vessels would dock in New York Harbor. Armed guards would escort gold bars from the Fed to the ships. The gold would sail to France, and France would accumulate thousands of tons while publicly supporting the system that allowed them to get gold at suppressed prices. This was strategic brilliance. Support the suppression publicly, while accumulating privately, get gold cheap, while other countries believe their own propaganda about dollars being superior to gold. Stage 2 was the revelation. By early 1968, private gold buying had overwhelmed the pool's ability to suppress prices. The Vietnam War was escalating. American deficits were exploding. Private investors around the world were losing faith in the dollar. They were buying gold, massive amounts. The London gold pool was selling hundreds of tons per month, trying to keep the price at $35. They couldn't sustain it. On March 17, 1968, the pool announced they could no longer maintain the $35 price. The suppression had failed. Private demand had defeated central bank selling. Gold price immediately jumped to $41, a 17% increase in days. Then it went to $50, then higher. The revelation that central banks couldn't control the price triggered a rush into gold. Everyone who had been sitting on the sidelines watching the pool suppress prices suddenly realized in the May suppression was ending. They rushed to buy before prices rose further. Stage 3 was the systemic consequence. The London gold pool collapse led directly to Nixon ending dollar convertibility to gold in 1971, just 3 years later. Because once private buyers defeated central bank price suppression, once gold started trading above the official $35 rate, the entire Bretton Woods system became untenable. Foreign central banks saw gold rising to $40, $50, $60 per ounce, while the U.S. still officially valued it at $35. They demanded to exchange their dollars for gold at $35 before the official rate changed. The run on American gold reserves accelerated. By August 1971, Nixon had no choice. End convertibility or watch Fort Knox empty out. He closed the gold window, ended the Bretton Woods system, ushered in the era of pure fiat currency, the secret accumulation by France and others, destroyed the post-war monetary system. It proved that dollar promises couldn't be trusted when they conflicted with economic reality. It proved that gold was real money and dollars were just credit instruments. The geopolitical consequences lasted decades. France gained enormous wealth by accumulating gold at suppressed prices. The United States lost monetary dominance and entered a decade of stagflation. The global economy fractured into competing currency blocks. Stage 4 was the gold price explosion. After Nixon ended convertibility in August 1971, gold went from $35 to $197 by 1974, a 463% increase in 3 years. Then to $850 by 1980, a 2,400% increase from the Bretton Woods price. The suppression ended. The secret accumulation was revealed. The true price discovery began, and gold exploded to levels that defenders of dollar dominance had called impossible. France, by secretly accumulating while others suppressed, gained enormous wealth. They understood gold's value, while others believed their own lies about dollars being as good as gold. They acted on that understanding, while the window of opportunity remained open. And they were rewarded massively when reality reasserted itself and gold prices reflected actual value rather than suppressed official rates. Now, let's jump forward 30 years. In 2001, European central banks announced the Washington Agreement on gold. They would limit gold sales to 400 tons per year for 5 years. The announcement was supposed to calm markets, show responsible management, but it revealed something shocking. European central banks had been selling gold secretly for years, thousands of tons. They had been dumping gold to suppress the price and support the dollar system. The revelation triggered immediate market reaction. Stage 1 was the secret selling. Through the 1990s, European central banks sold over 4,000 tons of gold. They claimed gold was a barbarous relic, that modern central banking didn't need gold reserves, that dollars and euros were superior stores of value. They were lying. They were selling to suppress the price and prevent gold from competing with their fiat currencies. Stage 2 was the announcement. The Washington Agreement admitted to the selling and promised to limit it going forward, 400 tons per year maximum. This was supposed to be responsible, but it revealed that they had been selling far more than 400 tons annually before it revealed the secret suppression campaign. Stage 3 was the market reaction. Gold price jumped from $250 to $300 immediately, then to $400 within 2 years. The revelation that central banks were sellers, not accumulators, actually boosted the gold price because it meant their selling would be limited going forward. The suppression was ending. Stage 4 was the long-term consequence. From 2001 to 2011, gold rose from $250 to $1,900, a 760% increase. The European Central Bank selling was revealed. The suppression ended, true price discovery began, and gold exploded. The same pattern played out again with central bank gold swaps in 2008. During the financial crisis, central banks engaged in massive gold swaps, lending gold to bullion banks. The gold showed up on central bank balance sheets as if it was in their vaults. But it had been swapped out, lent to banks. And the banks sold the gold into the market to suppress the price during the crisis, and this kept gold from spiking during the panic. Stage 1 was the secret swaps. Central banks swapped thousands of tons of gold to bullion banks. The banks sold it, used the proceeds to stabilize themselves. The gold appeared as reserves on central bank books, but was actually sold into the market. Stage 2 was the analyst discovery. Gold analysts noticed discrepancies. Central banks claiming gold reserves that couldn't be audited. Refusing to allow physical verification, the swaps started leaking out through leaked documents and whistleblowers. Stage 3 was the market realization. When investors realized central bank gold reserves were inflated, that gold had been swapped and sold, demand for physical gold exploded. If central banks didn't really have the gold they claimed, and then available gold was far scarcer than official statistics suggested. Stage 4 was the price surge. Gold went from $700 in 2008 to $1,900 in 2011. The revelation of gold swaps and central bank manipulation triggered a rush into physical metal. 3 examples: France's secret accumulation in the 1960s, European secret selling in the 1990s, central bank gold swaps in 2008. Each time secret gold operations get revealed, markets react violently. Prices move hundreds of percent, currencies get revalued, the global monetary system adjusts to the new reality. And right now, China's secret accumulation is starting to be revealed. The scale is far larger than any previous example, and the consequences will be proportionally larger. Before we talk about what happens when the full truth comes out, you need to understand why China has been accumulating gold in secret, not just to own a valuable asset, but to fundamentally challenge dollar dominance and create an alternative monetary system. China understands that gold is monetary power. Throughout history, countries with large gold reserves had currency credibility. When Britain held the world's gold, the pound was the reserve currency. When the United States accumulated the world's gold in the 1940s, the dollar became the reserve currency. The gold backing gives currency legitimacy. It provides confidence. It enables a currency to be used globally without questions about whether the issuing country will print too much. China wants the yuan to be a reserve currency, a global trading currency, an alternative to the dollar. But nobody trusts the yuan. China has capital controls. They manipulate their currency. They have a closed financial system. No country wants to hold large yuan reserves because there's no confidence in Chinese monetary discipline. Gold solves this problem. If China announces they have 15,000 tons of gold backing the yuan, the calculation changes completely. 15,000 tons at current prices is roughly $1 trillion in gold. That could back a significant portion of yuan in circulation. It would make the yuan partially gold-backed. Not a full gold standard, but enough backing to create confidence, enough to make other countries willing to hold yuan reserves, enough to make the yuan a legitimate alternative to the dollar. This is an existential threat to dollar dominance. The dollar is the reserve currency because there's no alternative. The euro is fragmented. The yen is from an aging, shrinking economy. The pound is a shadow of its former self. The yuan has been untrustworthy, but a gold-backed yuan changes everything. Countries could hold yuan reserves with confidence. Trade could be settled in yuan instead of dollars. Oil could be priced in yuan. The entire architecture of dollar dominance would face a legitimate competitor for the first time in 80 years. China is also using gold to insulate from sanctions. Russia had $600 billion in foreign currency reserves when they invaded Ukraine. Those reserves were frozen, seized. $600 billion made worthless by Western sanctions. The reserves were held in dollars, euros, pounds, all subject to Western control, all weaponized against Russia. China watched this closely. They realized that dollar reserves are a vulnerability, an attack surface. If China ever conflicts with the West over Taiwan or trade or anything else, their dollar reserves could be frozen too, made worthless. But gold can't be frozen. Gold in vaults in Beijing can't be sanctioned, can't be seized, can't be weaponized by the West. Physical gold held domestically is true sovereignty, true reserve, true wealth that can't be taken. By accumulating 15,000 tons of gold, China creates sanction immunity for a significant portion of their reserves. They can't be financially attacked the way Russia was. They have hard assets that maintain value regardless of Western actions. This changes the geopolitical balance of power. It makes China more willing to challenge the West, more willing to take risks, more willing to confront dollar hegemony because they have the gold to back their position. China is also preparing for the dollar's inevitable decline. They see the United States running unsustainable deficits, printing trillions, accumulating unpayable debts. They understand that the dollar's reserve status depends on confidence, and they see that confidence eroding. By accumulating gold now, while prices are suppressed, while Western central banks are still selling or swapping, China is positioning for the post-dollar world. When dollar confidence finally breaks, when a crisis exposes the unsustainability of American debt, gold will be the asset that matters. Countries with gold will have monetary credibility. Countries without gold will face currency collapse. China's making sure they're in the first category. They're accumulating the hard asset that has been money for 5,000 years. The asset that survives every fiat currency collapse. The asset that will back the next global monetary system. This isn't conspiracy theory. This is stated Chinese policy. They've published papers about gold backing for the yuan. They've discussed ending dollar dominance publicly. They've built gold refineries that process more gold than any country except Switzerland. They've created a Shanghai Gold Exchange to compete with London and New York. Every action points to the same strategy. Accumulate gold, build gold infrastructure, prepare for gold-backed currency, challenge dollar dominance. Now let's talk about what happens when the full truth comes out, when satellite imagery and shipping manifests and whistleblowers reveal that China holds 15,000 tons of gold or more. When the secret becomes undeniable, the market reaction will be immediate and violent. Stage 1, the initial shock. Check. We're already seeing this. The satellite image is leaked. Industry insiders are starting to talk. Gold jumped $20 on the news. Small compared to what's coming. But the initial shockwave investors realizing China might hold far more gold than anyone knew. This is just the beginning. Stage 2 will be the official denial, followed by admission. China will initially deny the leaks, call them speculation, dismiss the evidence. But as more evidence emerges, as more facilities get photographed, as more manifests leak, denial becomes impossible. They'll have to admit to larger holdings. Maybe they announce 3,000 tons, 4,000 tons, still less than they actually hold, but larger than the 2,000 tons they currently claim. This admission will shock markets because it confirms the secret accumulation was real. It confirms China was lying for years. It confirms the scale is massive. Stage 3 will be the market scramble. When China admits to even a portion of their true holdings, when they confirm the accumulation, investors will panic, not panic selling, panic buying, because if China accumulated 15,000 tons in secret, they did it for a reason. They're preparing to back the yuan. They're preparing to challenge the dollar. They're preparing for gold to play a monetary role again. Investors will rush to buy gold before China reveals their full hand, before they announce yuan gold backing, before the monetary system shifts. The scramble will drive gold prices up hundreds of dollars in weeks, from 2,000 to 2,500. The move will be violent, sudden. Gold will gap up $50 overnight, and then another $75 the next day. Technical levels will be meaningless, chart patterns will be irrelevant, and the buying will be fundamental. driven by the realization that gold is returning to its monetary role, that 15,000 tons accumulated by China isn't for decoration, it's for backing the yuan and challenging dollar hegemony. Then the price will hit 3,000 and then 3,500. The pace will accelerate because as gold rises, it attracts more attention, more buyers, more countries realizing they need gold to compete with. China's gold-backed yuan, central banks that sold gold in the 1990s and 2000s will panic. They'll try to buy it back, but from who? China's buying 15,000 tons over 15 years absorbed most available supply. There's nothing left to buy at current prices. Supply is tight. Mine production is only 3,300 tons per year globally. Annual jewelry demand alone is 2,000 tons. Investment demand is another 1,000 tons. There's barely any surplus, and if central banks suddenly need to buy 5,000 tons, 10,000 tons to compete with China's holdings, where does that gold come from? It comes from existing holders selling at much higher prices, from gold miners expanding production, from jewelry holders melting down their gold, from every ounce being repriced to a level that balances supply and demand. When central banks are desperate buyers instead of sellers, that price might be $5,000 and it might be $10,000. The market will discover it through violent price action. The scramble will overwhelm available supply, premiums for physical gold will explode, paper gold markets will break as investors demand physical delivery, futures contracts will settle in cash instead of metal. Because there's no metal to deliver, the London Bullion Market Association will face a crisis, and the COMEX will face delivery defaults. The exchange for physical programs will be suspended. The entire paper gold infrastructure built over decades will fracture because physical demand overwhelms paper supply. This happened in small scale during March 2020. 1-ounce gold coins were selling for $200 above spot price, premiums of 10%, delivery delays of weeks. The paper price said $1,600. Physical buyers paid $1,800. That was a brief dislocation. When China's accumulation gets revealed, the dislocation will be permanent. The paper price and physical price will diverge permanently. Physical will trade at massive premiums. Paper contracts will be ignored. The gold market will split into paper and physical with completely different prices. Stage 4 will be the currency impact. A gold-backed or partially gold-backed yuan will immediately become more attractive than the dollar, not to individual investors, to central banks, to sovereign wealth funds, to countries that hold trillions in currency reserves and need somewhere safe to store them. China will offer yuan bonds backed by gold. They'll offer trade settlement in yuan with gold convertibility. Not full convertibility like Bretton Woods, but partial, limited, enough to create confidence. A country could hold yuan reserves knowing they're backed by gold, knowing China has 15,000 tons to support the currency, knowing the yuan isn't just fiat promises but has hard asset backing. The countries will shift reserves from dollars to yuan. Not all at once, gradually, but consistently. Saudi Arabia will increase yuan reserves and reduce dollar reserves. Russia will shift entirely to yuan. Iran, Venezuela, North Korea, all countries under US sanctions will rush to yuan because it can't be frozen or seized, and then neutral countries will follow. India will diversify reserves, Brazil, Indonesia, South Africa. The reserve shift will accelerate from dollars to yuan, from unsupported fiat to gold-backed currency. The dollar will face selling pressure it hasn't experienced in 80 years. Since before Bretton Woods, since before the dollar became the global reserve currency. Foreign central banks reducing dollar holdings means selling treasury bonds and selling dollar assets, exchanging dollars for yuan. So this puts downward pressure on the dollar, upward pressure on treasury yields, and the Federal Reserve will face a nightmare scenario. Foreign selling of treasuries drives yield higher, and higher yields make US debt service more expensive. More expensive debt service increases deficits. Larger deficits require more borrowing, but foreign central banks are selling, not buying. So the Fed has to buy, print money to buy treasuries. This creates inflation, undermines dollar confidence further, accelerates the reserve shift, the death spiral. This will force the Federal Reserve to respond. They might announce their own gold holdings are larger than official statistics. They might propose gold backing for the dollar. They might try to confiscate gold from American citizens the way Roosevelt did in 1933. Whatever they do will be reactive, desperate, attempting to maintain dollar dominance against a gold-backed competitor. The currency wars will intensify. Exchange rates will become volatile. The stable monetary system of the past 80 years will fracture into competing currency blocks. Yuan, backed by gold in Asia, dollar struggling to maintain credibility, euro fragmented and weakening, the multipolar monetary system that analysts have predicted will arrive suddenly. You cannot secretly accumulate 15,000 tons of gold without it meaning something. You cannot build that position over 15 years without strategic purpose. You cannot hide that scale of accumulation without government-level deception, and you cannot reveal that accumulation without triggering massive market consequences. China has been preparing for this moment for 15 years, accumulating gold while prices were suppressed, building refineries and vaults and gold infrastructure, creating alternatives to dollar-based systems, preparing to launch a gold-backed yuan that challenges dollar dominance. The secret is starting to leak. The satellite images are emerging. The manifests are appearing. The whistleblowers are talking. And when the full scale becomes undeniable, when China can no longer hide 15,000 tons of gold, the announcement will reshape global finance. Gold will surge to prices that seem impossible. Today, $4,000. $5,000? Maybe $10,000? As the world realizes gold is money again, the dollar will face pressure it hasn't faced since Bretton Woods collapsed. Reserve currency status will fragment. The monetary system built after World War II will end, and a new system, one where gold plays a central role again, will emerge. If this revealed something about China's strategy that you didn't know, if this connected dots that the mainstream media isn't connecting, you need to subscribe to this channel immediately. Hit that subscribe button right now. Smash that like button. Because when this story fully breaks, when China's gold accumulation becomes front-page news, when markets are reacting violently and everyone's asking what it means, you'll already know. You'll understand that this was 15 years in the making, that China prepared systematically, that gold is about to play a monetary role again whether Western central banks want it to or not. The evidence is mounting. The leaks are accelerating. China's secret gold accumulation is going public, and investors who understand what's coming are already positioning. Make sure you're subscribed, because this story is just beginning. The full revelation is coming, and it will change everything.